In what way has operational risk gone up for multifamily?
Well, people want more. They want a hyper amenitized multifamily experience. I'll give you one tongue-in-cheek funny comment. So one of the hip areas in multifamily now where it's going is co-living. Co-living is essentially smaller units, bare bones within your unit, and everything in the common areas is being provided to you. I call co-living, tongue-in-cheek, senior housing for young people, because what they're getting are those types of amenities in their buildings. Now, they're not getting the same level of care as you're getting in a senior housing facility, but they have the pool table, they've got the bar, they've got the food, they got everything, right? But here's the thing about senior housing as distinct from co-living. What really makes it much more expensive to operate senior housing is that there's, number one, a tremendous labor shortage out there, hard to get help. And number two, that labor has gotten very expensive. And so senior housing still has a pretty big cap rate delta, meaning it's much higher than the typical cap rate is for regular multifamily because their operational risk is so high relative to the base asset class.
Right, and that's the same for hotels. So the distinction that you're making is that which is more hands-on, that requires greater management, like senior housing, like hotels. These kinds of assets are basically businesses. So you're running a business as well as operating.
Well, that's right. And one of the key questions that landlords need to confront today is how much do they want to run it like a landlord and how much do they want to run it like a business? And that's a key question, particularly in retail. So what you've seen in retail recently is several high-profile bankruptcies of large retailers. You know who's been bailing out a lot of these retailers? The landlords. They're buying the retailers so they can continue to operate in their malls. And the question is the landlord now the operator, or are they the landlord, or are they both? And in the case of co-working, you're seeing something even more interesting, where in many cases, you're seeing the landlord being the operator or doing it directly or in joint venture. So they're directly given these short-term leases to the short-term operators or the smaller tenants. And so in that case, there is no lease. It's just the cash flow. And here's the key question. So why wouldn't a landlord do that? Why wouldn't a landlord take more money for a shorter-term lease with a small tenant? Makes sense, right? One big exception. You get a lower multiple on that. It means the cap rate is higher. So let's assume that the typical multiple in your building is a 20 times multiple or a 5 cap. Okay, let's assume that, right? If you have $1 of NOI from a traditional lease, they're going to multiply that $1 by 20 to give you the value of your building. Are they going to multiply that $1 from that co-working space by 20 when they value your building? That is the key question, because the market has not yet moved to the point where they're willing to accept a dollar of cash that doesn't come from a traditional lease and value it at the same cap rate as operating income.